Okay, so what we're going to be talking about today are your three major ways in which you can finance a property using other people's money. Now, I'm going to take you through these three different routes, and as much as this is going to be an educational session, you might want to even listen to this webinar two or three times, because I'm going to run through a couple of really important aspects of raising finance, and I'm going to go through it relatively quickly because we only do have an hour together. So if you do have questions, pop them in the questions bar. Otherwise, let's jump right in. So the first and probably the most common way that you can raise money on property is to use institutional finance. Institutional finance is a fancy word for bank money, for traditional bank finance. Now, what's interesting is that most people are aware of bank financing. They're aware of, the top five banks being your Netbank, your FNB, your ABSA, Standard Bank, etc. But what you might not know is that there are over 52 registered banks in South Africa. You've got banks like Mercantile, Tough, the Bank of Athens. You've got Combined Finance, Sentinel Homes. These are banks that they don't necessarily look at your affordability as a person, but they actually look at the deal, and they are willing to finance a deal based on the validity of the deal. So it's important to know that as much as you want to be looking at institutional financing in terms of looking at the bank's money, remember that there are many other registered banks that might provide you with more competitive rates and um, give you essentially a better deal without having the affordability to justify it. So let's jump into the financing terms. Now, when you are looking at getting a loan from an ABSA or a bank, you need to understand their terminology. So, quite simply, the first one is LTV. Now, LTV stands for loan to value. If you've got a value of a property, let's say the value is R1,000,000, a 90% LTV means they are willing to loan you 90% of R1,000,000. The remaining 10% you have to put down, and we call that a deposit. Right? Then you've got a loan term. This is the length, the time in which you get to pay this loan back. The most common is 20 years. You can also push it up to 30 years. And then when you're looking at commercial loans, you often are looking at 15 to 10 years. And then your final term that you have to understand is interest rate. Now, this is the interest that they're charging for loaning you the money. So let's look at an example. Let's say that you're loaning R1,000,000. That's the value of the property that you're purchasing. You've signed an offer to purchase and you've agreed R1,000,000 for this property. If the bank is going to give you an 80% or a 90% loan, they are going to be loaning you those two figures. They're either going to loan you 800,000 or they're going to loan you 900,000, depending on the LTV, right? Based on the interest rate of 10% over 20 years, that's going to be your monthly payment. Right, so when you're looking at a deal, a student accommodation deal in Durban, or you're looking at a buy-to-let in Cape Town, or you're looking at a multi-let investment in Joburg South, you have to make sure that the income you're receiving on a monthly basis is big enough to pay off all your monthly expenses plus pay off your loan. Now, what you could do if you wanted to is you could either reduce that interest rate, which will reduce the payment, or increase the loan term. If you increase it from 20 years to 30 years, it will reduce the payment per month, and it might make your deal cash flow positive. So I'm hoping that, the next time you do receive a an opportunity and you want to go and approach the bank, when they say LTV, you must know loan to value. Loan term is period in which you must pay it off. Interest rate is how much they're charging you for the facility to loan money. Now, there are three key criteria that the banks look at when looking to loan you money. One is your credit score. Now, I like to use a product called clearscore.com. So that's www.clearscore.com. It's a free service and it gives you what your credit score is. So you can see here, this is an example of mine, 676 out of 705. That's very good. Go check yours out. And if yours is below 500, I think if it's under 500, don't approach the bank. Because even if the deal is great and even if your salary is big enough to justify a loan, the bank's are going to say no, because they're going to look at your credit score and they're going to say this person is too risky to give a loan to. So if you do have less than 500 as a score, my recommendation is to go and find out why your score is so low. You might have an unpaid debit order with Vodacom, or you might have a card, Edgar's card that you haven't paid off and they've blacklisted you, or you might have defaulted on a payment, or maybe it's something you didn't even know that you were defaulting on, a subscription that you don't remember signing up for, but they've blacklisted you. Make sure that your payments are sorted out. Get your credit score to the right level, because if your credit score is not good, no bank is going to lend to you. The second criteria that a bank looks at when wanting to loan you money is looking at your affordability. Now, your affordability is essentially how much do you earn per month and how much can you afford to pay per month in terms of your salary. Now, the rule of thumb is a third of your salary is what the banks use to justify what they will loan you. So, for example, let's say that you are earning 30,000 Rand per month. A third of 30,000 Rand is 10,000 Rand, which is then what the banks will qualify as your affordability. And that'll roughly get you a loan of about R1 million. So you can quite quickly work out, and you can also obviously go to any of the banks and ask them for pre-approval. Say you'd like to get pre-approved for a bond, how much could I afford? They'll ask for your income and your expenses, and they'll give you a quick number and say, fantastic, based on your results, you could probably loan 1 million or 1.5 million. And then the third criteria that they look at is they look at the deal and the investment itself. Okay, so let's look at some options that you have if you're looking at institutional finance. You've got bank finance. This is where you've got your ABSAs, your net banks, your standard banks, etc. Credit card is another form of institutional financing. Now, sometimes people get a bit confused and a bit uncomfortable with this because we've been taught that credit cards are bad. And yes, credit cards are bad when you're investing with your credit card for luxuries, lifestyle, and travel. But when you're using a credit card for an asset purchase, when you're looking at buying education, or when you're looking at buying a home and you're looking at something that's going to bring money back in, using your credit card is a great method of accessing other people's money. Now, I usually recommend that, when you're buying a property and you have to pay for transfer fees, your transfer fees are usually 20, 30,000 Rand. I say, use your credit card. That's a great opportunity for you to use your credit card for that kind of purchase. And then 6 to 12 months later, once you've sold the property or you've made some profit from a rental point of view, you pay off your credit card. And what you're doing then is you're showing the bank that you know how to work with credit. Another rule that I like to put in place is do every single purchase that you do every month, do it through your credit card. Groceries, petrol, everything. And then at the end of the month, make sure you're paying off that credit card so that it's not in any debt at the end of the month. Because what you're doing is you're showing the bank that you know how to work with credit. Just using your credit card and repaying it every month is already going to get your credit score at a much higher level. An overdraft facility is another example of bank finance. So maybe go and speak to your finance guy at the bank, or go and just approach the bank in general and ask, do you qualify for a credit card? Do you qualify for an overdraft facility? And again, I just want to stress this: please don't use these methods to buy luxury or lifestyle items. Please don't buy a trip to Fiji or a brand new TV with your credit card, because that's a liability and it's going to make you in a worse financial situation. But if you can get access to other people's money through a credit card or overdraft, and you're investing in property, I say that's a great idea. An equity release, I'm going to show you an example of what that is. It's a very powerful strategy. And then bridging finance, I'm also going to show you what that is. Okay, so let's jump in and let's look at bank finance in a little bit more detail with a deal, and then let's look at equity release. So bank finance. Here's an example of a deal that I did using the bank's money. So the asking price of this deal was 850, purchase price of 645. Remember, we always buy at a discount. It's very, very important that when you're looking at flipping a property, which means buy low, force the value of the property to go up by, renovating it, and then sell high, that's a great strategy that you can use if you buy low. But you have to buy at a discount. I put a deposit down of 10%, which means I got a 90% loan to value. Refurbishments were just under 40,000. The legal costs, the transfer fees, and the bond registration fees were 23. My holding costs for 6 months, remember those are the costs associated to holding the property, was 24,500. And the property was marketed or valued at 950 when I sold it, made a profit of 157,000 Rand. Now, this was a great deal because I used the bank's money to do the 90% loan. I then used also my credit card to pay for the holding costs and the legal costs. And after the 6 months, once the property sold and transferred into the other person's name and I got my money back, I paid off my credit card and I still walked away with a profit of 157,000 Rand. So I'm hoping that you can see this is an example when you're looking at a normal 2-3 bedroom house. You've got the right affordability, your credit score is in the right space, and the deal makes financial sense because you've analyzed the numbers and you've got confidence in making a buying decision. You can use the bank's money quite easily to get started in property. Now, the terms that I received from Standard Bank, who was my financer in this deal, was a 90% loan to value at an interest rate prime minus 0.05, 75, sorry, and the terms was 20 years. I've obviously paid that off because I sold the property within the 6 months. Now, the conditions of the loan, right? When you are applying for a loan, the banks are going to expect that you give them a proof of residency, a proof of income, and a proof of deal validity. So essentially what you're looking at is you have to give your FICA documentation, your proof of ID, your proof of residence, etc. You have to do a proof of income, show that your affordability is good enough for the deal. And then especially when you're looking at doing an investment property and you want to get better terms, you need to go there with some sort of investor proposal, show them how the numbers work, and make sure that it's a financially viable deal. So here is an example of a conversation that I had with ABSA Home Loans recently. I was looking at getting a loan from them for a potential multi-let. And here you can see some of the conditions that they've asked me for. They wanted ID copies of my company directors. So I'm purchasing this property in a company. So they want the ID of all the directors within the company. They also want to know what the shareholding is, the latest CIPC registration documents, 3 years of audited signed financials. So that's very important. When you're buying in a company, you're going to need at least 3 years track record in order for the loan to be put through the company's books. Now, there is a caveat to that. If you don't have 3 years of trading history, what you can do is you can put the company into your you can put the property into your company name, and as long as you take personal surety, you can still run the deal through the company. So that's a way in which you can get around it. But if you are trading through a company and the company's been trading for 3 years, you'll need to give those 3 years of signed financials, the property's rent roll, signed offer to purchase, and 3 months bank statements. So that's just giving you a little bit of a sense of when you go through this loan application process, these are the steps you need to take, and it's just about getting the paperwork in order. My pro tip for you regarding bank finance is go to your bank today. Okay, not today. Obviously we're in a bit of a lockdown, but you can still email them. Go and speak to your banker and find out what can you be approved for today. So get that pre-approval because then you know what kind of deal range you can work with. If you're on the spectrum where you're earning 20 to 30 to 40,000 Rand, you know that you could probably purchase a property within the million Rand range, and you know which kind of areas you can then focus on because you know what your price bracket is. If you're on the lower side of the spectrum, maybe you're starting your career or you're not receiving the income that reaches that level just yet, and maybe you're on the 10 to 15,000 Rand, then you're going to obviously have to manage your expectations down. You might then qualify for a loan of 200 to 300,000 Rand, which then again it directs you into which areas you can start your investment journey. Here's an example of a bridging finance. Now, I've spoken very briefly about the 52 registered banks. You've got your 5 big ones, and then you've got all the other guys on the side. You've got your Tufts, you've got your Mercantile, you've got your Combined Finance, Sentinel Homes, you've got Mercantile, Bank of Athens, you've got all these other banks that are very, very interesting because they do not always consider your salary. Now, that's very, very important. What I'm basically saying there is that you could be earning little to no money and still get a loan from these kind of financial institutions. The only risk with that is that they tend to give you much higher interest rates and over a shorter period of time. So, for example, this specific deal, is a company called Combined Finance. They are willing to give me 70% loan to value. So you can see the purchase price is 1.5. I have to put down a 30% deposit plus my transaction costs, which are my transfer fees, etc. They're willing to loan me just over R1 million, and the interest rate is 11%, which is prime plus one, which is still pretty competitive, to be fair. If you're looking at someone like a Tough, they'll also only loan you 70% loan to value at about a 13% interest rate. That's their minimum. Now, what's interesting about Tough is that they are willing to loan you 70%, and then they are also partnered with another fund called the Tutuka Fund. And the Tutuka Fund are willing to give you the other 30% if you qualify for certain, there's like certain BEE standards that you have to qualify for and certain income levels. I'm not exactly sure how it works. I haven't done it myself yet, but there are options out there. And I'm hoping what you get out of this first section is that bank financing is a great way in which you can get started in buying a property investment. So we've looked at bank financing. Let's look at the equity release. Now, there are some people on the call today that have, are starting their property journey today, and some people that already have a few properties that they've already bought. For those of you who have already bought properties, this is a very interesting strategy for you to access some more capital. Now, this is a student accommodation property that I bought a couple of years ago. It's a 6-bedroom house in the Auckland Park area in Johannesburg. Now, the financials of this deal are quite simple. The agreed price is 1.2 million, rental of 26, monthly operating expenses of 21. The profit is 5,000 Rand per month, so income minus expenses, minus all your bonds and all of those costs. I'm left with 5,000 Rand passive income, which is a decent return on investment. Now, the way that we financed this deal was, one, we got a R1 million home loan with FNB. We used 40,000 Rand of my credit card to pay for some transaction costs. And then the additional 200,000 Rand that I needed, I did an equity release from my primary residence. So now here's where the equity release comes from. Equity release. So the property that I live in Johannesburg is valued at 1 million Rand. That's the value of the property. Now, I bought this property probably about 6 or 7 years ago. And over the last 6, 7 years, I've paid off a substantial amount of the debt, right? So the current bond is only sitting on 700,000. Now, what this means is that the value, the difference between the value of the property minus the outstanding bond is called your equity. Right? The difference between your million Rand and the 700,000 Rand equals 300,000 Rand. That's equity that I'm sitting on. Now, what I can do is I can go to the bank and say, listen, bank, I have got 300,000 Rand in equity in my property. Can I please release that equity? Which basically means that the bank is now going to issue you a new loan for the value of R1 million, which means you're going to receive 300,000 Rand in terms of a access bond from the bank, which you can then put into this next property investment. So if you're sitting on a house that's got a little bit of equity, you can approach the bank and ask them for an extension of your loan, increase the loan amount, get some of that capital out and invest it in your deal. Now, my pro tip on this section is it doesn't have to be your own home for you to release the equity. Right? You could have a friend or a family member or a cousin or an uncle or a business partner that has a property that has got a lot of equity on that property, and you could get into an agreement where you loan the money from them. Right? You don't have to have your own property to get money, but you need someone's collateral that you can go to the bank and use to be able to extract money from the bank. Right? You could, a friend's car. You could put a friend's car on the line. Now, you have to make sure that the deal makes a lot of financial sense, because if the deal falls through, your friend is going to lose their car. If the deal falls through, your business partner, your friend, your family member's house is going to be repossessed. Now, you don't want to be putting your family or your friends into such kind of situations. So you have to make sure the deal makes sense. But remember, we have to think creatively. We have to think outside the box. Is there an asset that you have that you can release equity out of? That's the question you got to answer. So that was institutional financing. I hope that added a bit of value and that you saw some possibilities. Let's now look at private finance. This is where we start working with investors and private wealthy individuals. Now, let's talk about the private financing terms. Loan to value. Now, there's not necessarily a loan to value when you're talking with investors. When you're talking with investors, you're talking about amount to loan. You're not talking about loan to value. So, for example, you might get R1 million loan from the bank for a property, and you might need another 200,000 Rand for the renovation cost. You would then loan the 200,000 Rand from the investor. So, you would rather go to an investor with a specific amount as opposed to a loan to value. The loan term is usually short to medium term. You're looking at 6 months on some deals, as short as 6 months to about 5 years. I wouldn't say you want to go longer than 5 years. And the interest rate is usually sitting at about 15 to 20%. That's why you don't want to have a too long a period of time, because eventually the interest is going to kill you. It's just too expensive. Okay, so let's say you're loaning that 200,000 Rand. Um, Now, you can get 40% or you can get 60% from an investor. So you've got, I don't know, you're buying a property in town, a Berea investment, and you need 200,000 Rand. If you were to loan 40% from an investor, you were to loan, 80,000 Rand. Or if you were to loan 60%, you would loan 120,000 Rand. Now, investor one, investor orange is charging you 15%. Investor blue is charging you 18%. Investor Orange is charging you, 15% over 2 years, and Investor Blue is charging you 18% over 5 years. So we're going to compare now. If we had to loan 200,000 Rand from two different investors, Investor Orange and Investor Blue, which one do you think is going to be the most expensive? So what's interesting here is, although you're loaning less from Investor Orange, you're paying more in terms of monthly expenses to Investor Orange than you are to Investor Blue. The reason being is because of the term. Okay, so again, running your numbers, ladies and gentlemen, that is incredibly important. So we need to make sure that you're confident in your deal analysis, because that is going to be the basis for all your successful deals going forward. Okay, let's jump to the next one. Now, the key criteria that a private investor is going to look at when considering investing in your deal is risk protection, repayability, and structure. Risk protection, repayability, and structure. So let's look at some examples. Right, you've got angel investor finance, friends and family, colleagues and acquaintances, networking events, stokvel, joint venture partnerships. Now, when you find someone who's going to become your private financier, we call them an angel investor. The question I always get is, where am I going to find these angels? Right? Your angels are in that list below. Friends and family. Now, some of us are luckier than others, I guess, in this respect. Some people do have wealthy family members and wealthy friends. If you do, and if you are lucky like that, use the opportunity, go and leverage as much as you can from them. If not, maybe it's time to start looking at your colleagues and your acquaintances. I remember the first deal, the first time I approached an investor, it was actually through our company secretary. So I remember it was my sister and I working on a deal, and the secretary that was working at my company was a very good friend of mine, and we had put this really nice investor proposal together, and we were going to approach a whole bunch of investors with it. And I just wanted someone to proofread it and make sure that the spelling was correct and that it looked nice. So I went to my friend who was the secretary, and I sent her the deal, and I said, please, can you just have a look through it and tell me what you think? And I got an email back a couple of minutes later saying that she actually had 200,000 Rand saved up, that she's been wanting to invest in property. And yeah, funny enough, she became our first angel investor. And the reason I tell you that story is that you never know who your investors are going to be. You never know, the friends, the family, the people that you're around. You never know if somebody's been saving 200,000, 300,000 Rand here or there and has some money to invest. Networking events, I would recommend that you go to www.sapropertynetwork.com. That's sapropertynetwork.com. It's the biggest property networking company in South Africa. I'm closely affiliated with them. The founder of that company, Andrew Walker, is a good friend of mine. He was my coach back in the day, and they host and run events every month. If you want to start meeting investors, if you want to start meeting people who've got money, who have got deals, you have to be at these events. You have to be attending on a monthly basis. So go check out their website. I highly recommend that. Stokvel crowdfunding. Sometimes you don't need 1 million rand from one person. You might just need 100,000 rand from 10 people. So is there some people that that they might not have millions, they might have a couple of thousand, and they're willing to come together and contribute? I've got this one coaching student. She and about 10 of her friends are not big earners, and they stay in a very they come from a very impoverished background. But what they've committed to doing is each putting 2,000 rand into a shared bank account every single month. There's about 10 or 15 of them putting 2,000 rand into the account every single month. So every month is growing by 20 to 30,000 rand. And in the next 6 to 12 months, we'll be able to buy a property in Berea cash. And then it's going to take them another 9 months to buy the next property, and then another 6 months, because they're going to be constantly contributing to this stokvel, which is great. Now, the last one that I wanted to talk to you about was joint venture partnerships. Now, you can either loan money from an investor, so you can go and find a very wealthy individual and loan money from them, or you can partner with someone and bring their money into the deal. So let me show you an example of a partnership. This is a deal that this is probably my most recent deal. It's in Rosettenville in an area called Forest Hill. It is on Reader Street. So I'm sure that those of you who are from the south, who know the area, you might even know the street. It's a block of flats. There are 4 3-bedroom flats on this property. So it's 4 times 3-bedroom, fully let block of flats. The financials are really great. So we agreed a price of 1.5, a rental of 24. The operating costs, the monthly costs of this deal is 10,000. The profit that we're walking away with is 13,500. So once I found this deal, I used the My Property app to build an investor proposal, which I will show you at the end of this workshop. This is a professionally designed financial proposal, which I then took to a bunch of friends, I took to colleagues, I took to everybody, and I said, who wants to go into this deal with me? Who wants to invest? And that's when I met a guy by the name of Clinton Middleton, who has subsequently become a very good friend of mine. And we went into a joint venture partnership where we decided to split the costs 50-50, split the profits 50-50, and he has become my joint venture partnership. And we have bought this property in a newly registered company. So this is a great way in which I have now halved the cost of this property, right? I don't have to put down 1.5 million anymore. I have to put down 750,000 because I've got somebody else who is going to put 750,000 rand down. So I've now reduced my cost to buy this property, and also what I've done is I've protected myself a little bit. Now that we're in this partnership together, we're going to share the profits, but we're also going to share the losses. Unfortunately, with this COVID situation, and because we rent mostly to lower income earners, guys who don't have the luxury of earning during this COVID pandemic, it means that I might, likely I won't be receiving rent for the next couple of weeks, maybe even months from this deal. Now, if I had bought this property myself, that would be my financial burden to do on my own. But now me and Clinton get to share that burden, and it's just made my stress levels a lot less, which is fantastic. Now, you can go the partnership route, or you can go the loan agreement route. This is where you're loaning money from an investor at a certain interest rate for a certain period of time. So here's an example, another block of flats in Rosettenville. The numbers on this deal make a lot of sense. So I bought it for 1.35. This is what it looks like on the inside. It's really clean and, well looked after. The rental that it's generating is just over 27,500. And the numbers make a lot of sense, right? So the rent coming in is 27,000. I've now got a loan with an investor where I'm paying him back over the next 12 to 15 years. And every single month I need to pay him 13,000. And he's loaned me the full amount, right? He's loaned me the 1.35 million, which is fantastic, Rates and taxes, insurance, management fee, maintenance. After all expenses and paying off my investor, I'm still walking away with about 7,800 Rand. So this is a fantastic deal, and it's made enough financial sense that I've gotten an investor, someone I didn't know before I'd met them. I met them at a networking event. I got the full 100% loan to value. So the agreement between this investor, right? It's all about risk protection. Remember that risk protection. So what I've said to this investor is that they get the first charge over the property. What that means is if I default, if I'm unable to pay this investor back, they can claim from the bank, they or not from the bank, they can get the first claim off the property, i.e., they can basically repossess the property and they can sell it or they can own it themselves. So that's essentially what first charge means. The second key consideration is repayment. Now, you've got to make sure that your cash flows, i.e., the rent that you're receiving, is good enough to pay back the investor. It has to make business and financial sense. And then finally, structure. I've got a 15-year loan with the specific investor. If I do default, he automatically takes over the property, and I've bought it in a company name where he is also a shareholder until I've paid off the property. So in a way, if you can make sure that your risk is protecting your investor, the repayment, and it's got a strong repayability, and your structure also benefits the investor, I see no reason why someone would not loan money to you. Now, here's just a 15-year projection of how this deal will do. As you can see, over the next 15 years, the green bar is the rent, which is increasing by about 5 to 7% per month, per year. And then the expenses are also increasing, but luckily I've got a fixed interest rate with my investor. So for the next 12 years, my interest payment's not going to change. And then at the end of 12 years, I would have paid off my investor. So that's why you can see here on the right hand side of the screen by the number 13, that's the 13th year. My expenses almost half because that's when I've paid off my loan to the investor. The difference between the green bar and the red bar is my profit, or also known as my cash flow. So you can see here's how the cash flow trend goes. As soon as 12 years are up, it shoots up. And by the end of 15 years, this one deal will be bringing me about 93,000 Rand per month. So this is fantastic, and this is why property is such a great investment vehicle. And I really applaud and appreciate everybody on the call here tonight, because you're sitting after work, after a long day at the office. You're sitting here trying to learn and upskill yourself in probably one of the best asset classes in the world. So I really applaud that and appreciate it. Fantastic. That was private finance. Now we're going to jump into creative finance. And I know that this is where everybody was most excited, because this is where we're looking at how can you invest in property with almost none of your own money. Okay. So this is buying real estate with other people's money. That just has such a nice ring to it, doesn't it? It's just got to sound like you're using somebody else's money to make yourself money. I love the idea. Okay, so let's look at some examples. You've got seller finance, the back to back, the rent to rent, and finally the lease option. So let's look at each one of these in a little bit more detail, starting with seller finance. Now, seller financing is a very interesting strategy. Imagine that you found a property, let's just call it in Kempton Park by the Oliver Tambo Airport. And the deal makes a lot of financial sense. Okay, you found this highly distressed property, this highly distressed seller. And if you renovate the property with, let's call it 100,000 Rand, you're going to walk away with a profit of 200,000 Rand. Okay. Now, the only problem is you don't have the ability to raise R1 million to buy this property. Now, instead of buying the property and paying for the renovations and going into all kinds of loans and debts and etc. to try and make this deal happen, why don't you get into a partnership with the seller? So what you could say to the seller is, look, you're in a bad situation. This property is not looking good. You're not happy. You want to move. I obviously want to help you, but I can't afford to buy the property. Why don't we get into a partnership? So get into a partnership with the seller where you don't actually buy the property. All you do is you pay for the renovation costs. So all you're doing is you're paying the seller to fix up their property. Once the property is in good condition, you can then sell the property and split the profits. Now, it's a win win situation, right? Because the seller is going to get more than they're expecting or more than they're bargaining for. You're winning because you only have to pay for the renovation cost. You don't actually have to pay for the property investment at all. You don't have to find that R1 million to purchase the property. And the truth is, you don't really need to own the property to make money off the property, right? The seller can keep their property. They can keep paying the monthly fees and monthly expenses. All you need to do now is you need to go and raise 100,000 Rand to fix up the property, force the value of the property to go to 1.5 million, sell, and you split the profits. So it's a very interesting strategy, but what you got to look out for is the legalities. You have to make sure that you've got strong contracts in place to protect yourself, right? Because if you're going to put 100,000 Rand into this person's property, and after you've renovated their property and it looks amazing, what if the seller comes back to you and says, well, thank you for that. I am now going to continue living here. Thank you for renovating my house for free. So you got to make sure that you've got some strong contracts in place. To ensure that if the seller does back off, you can at least recover your renovation costs. That's the only risk I see with seller financing. But otherwise, probably one of the best ways in which you can use the seller as the bank instead of trying to raise the R1 million yourself. Let's look at the back to back strategy. Now, oh, sorry, first let's go to the rent to rent. Okay, now rent to rent is, I kind of feel like this is the golden what is that saying? The goose that lays the golden eggs? I think that's the one. Yeah. This is the goose that lays the golden eggs. Now, this is a student of mine, and he is investing in the rent to rent strategy in Kenilworth in Cape Town. Now, the concept of the rent to rent is quite simple. You rent a property from an owner for X amount of money, and then you sublet to a whole bunch of other tenants. Now, you need to make sure that you're subletting it for higher than what you're renting it from the owner. So, for example, this is a great strategy that can work near a student accommodation area. Maybe Bloemfontein or Kimberley or close to UKZN or close to the University of Cape Town or Joburg. If you can find a nice old house, maybe 5 or 6 bedroom house, you can rent that from the family, from the people that own that for, I don't know, 10, 15,000 Rand maybe. Now, if there's 6 or so bedrooms, you can then put 2 students in each bedroom, renting each room or each bed for maybe 3,000 Rand. So let's say you've got 6 rooms with 12 students in the 6 rooms. Each student is paying 3,000 Rand. That's 3 times 12. That's 36,000 Rand in terms of a rental that you're receiving. The rent you're paying is 15,000 Rand. That means you're making 36,000 Rand as a revenue. Your expense is 15,000 Rand. You're walking away with a bit of cash flow. Right? Does that make sense? That's the concept of rent to rent. So, in the Claremont area, this is a sky view of the property that he's done the rent to rent with. It is a Airbnb slash guest house. The current owner of the property, he's just fed up and he doesn't want to deal with all these different tenants. He doesn't want to have to manage constant inflows and outflows of people. So he's in the perfect position to say to my student, just pay me 30,000 Rand per month and you can sublet it all you want. Right. The key with this deal is you have to be transparent with the owner. You can't not tell them that you are subletting the property. You have to be very clear about that. So here's the pictures of the inside of the property. You can see that the property is currently catering for tenants or Airbnb kind of guests. What's great about it is that this property doesn't really need to be renovated much to be ready for students, right? I mean, I think a student would be very, very happy to stay in a place like this. They've got their TV, bedroom, a small kitchenette, they've got plenty of cupboard space. So it's kind of a perfect situation where, I think it's just the right person, the right place. Now the numbers, right? He's renting out this Airbnb for 65,000 Rand. I think there's 17 students, if I'm not mistaken, each paying about 4 or 5,000 Rand. The owners only asked him for 30,000 Rand. Now, my student still has to pay all of these other costs, right? He still has to pay the insurance, the rates and taxes, the water and electricity, the Wi Fi, and provisions. He's putting some money aside in case one of the students stops paying, right? Because if a student stops paying, you can't now go to the owner and say, sorry, one of my students isn't paying. I can't now afford to pay you the 30,000 rand. That's not how it works. The whole point of this deal is you're renting from the owner for 12 months at 30,000 rand. You've got to do whatever it takes to pay him that 30,000 rand. The months that you do well, the months that you earn more than 30,000 rand, you can then keep those profits. The months where you earn less than 30,000 rand, you've got to hustle and you've got to find a way to pay him. So that's why they're putting aside about 20% provisions every single month, because they know that there are going to be some bad months, and then they've got some money saved up. After all expenses, they're walking away with 12,000 rand passive income, and they haven't bought the property. They haven't put anything into the property. They barely renovated it because it's already in great condition. So, ladies and gentlemen, is there an opportunity for you to rent from someone and then to sub rent to someone else? Very, very cool opportunity there. Let's look at the back to back strategy. Now, the back to back strategy is also very, very powerful. This is a good colleague of mine. His name is Leroy, and he's standing in front of the house that he recently back to backed. Now, the back to back strategy is where you make profit off investing, but you don't spend any of your own money. So, let me quickly take you through the numbers. He agreed a price for this property for 350,000 Rand. If I'm not mistaken, this property is in the Boksburg, Joburg East area. So 350,000 Rand. The refurb costs are zero, right? The property's in good condition. This is a distressed seller, someone who is motivated for whatever reason. Maybe they've been retrenched or they're looking to relocate or whatever it may be, but the property is in great condition. Attorney fees, 8,000 Rand. He's in the deal for 358. He sold it for 520 and made a profit of 162,000 Rand. But the beauty of this deal is that he used none of his own money. Now, the concept is pretty simple. Okay. What Leroy did is he signed an offer to purchase, which is a sale agreement with the seller for 350,000 Rand. Okay. And in that agreement, he specified that he needed 3 months to access the capital. So he basically said to the seller, I'll buy it at 350, but you've got to give me 3 months to find the money. Now, the seller was so desperate, they hadn't received any other offers, and they signed the document, which meant that Leroy now had a secure deal at 350,000 Rand for the next 3 months. He then went on a spree of trying to find other investors to buy the property from him, and he came across these two brothers who actually wanted to live in that area. And he said to them, well, I've got this property and I'm happy to sell it to you. What are you in the market for? And they said, well, we've got about 520,000 Rand. That's sort of what we're willing to pay for it. And Leroy signed an offer to purchase with them. So essentially what he was doing is he played the middleman between two people. He found the buyer, being these two brothers, and he worked out a deal with the seller for 350,000 Rand. So he almost played the role of an estate agent, if you can put it that way. He found a distressed seller, he found a hungry buyer, he brought the two together, and once the deal transacted, he got a commission, and he got his commission off the sale. Now, when you're doing this kind of deal, you have to be very careful that you're doing it legally, right? You need to make sure that if you're making a commission off any property transaction, that you have to be registered with the Estate Agents Affairs Board. Okay, if you're seen making a profit or a commission off a property transaction, the EAAB will fine you if you're not registered with them. Now, there are ways in which you can source a deal without being registered with the Estate Agents Affairs Board. You have to be quite clever with your legal agreements and making sure that they are worded in the right way. I'm very happy if you do have a deal that you think could be back to backed, for you to email me. I'll introduce you to my property attorney, and they'll be able to structure a deal that is 100% legal without you needing to be registered with the Estate Agents Affairs Board. Okay. Fantastic, ladies and gentlemen. That is the end of the creative finance section. We have another 10 minutes left, and I'm going to quickly open up the questions bar and see how many of these questions we can answer before I bid a farewell to everyone. Okay, so starting here, which is better, student accommodation or leasing the flat to the working class? Now, that's a great question. You need to make sure that the deal makes financial sense. So, when you're looking at student accommodation, you need to use a vacancy rate of 12 to 16%. Now, what I mean by that is November and December, the students aren't going to be paying you rent because they're on holiday. So you have to make sure that the deal still makes enough financial sense, even though 2 months of the year you're not making any money. Whereas the working class, you don't have that problem as much because the working class will rent for a 12-month period. So the difference between the two is the one works on 10-month leases, the other one works on 12-month leases. Whichever one brings a better return on investment is the one that I would recommend that you do. Okay. The next question. Hi, Lawrence. We got approved for a bond of 1.1 million on a property that we offered 1.9 to the seller. So you received a bond of 1.1 on a 1.9 offer. I would like to know if there is a way to involve the seller in the sale to suggest a payoff for the deposit of 800,000. Huh. Okay, so you've essentially got a agreed price of 1.9 million. You've only received a 1.1 loan from the bank, which means you need to come up with an 800,000 rand deposit, which is yeah, which is kind of crazy. I'm not sure if you can get the seller to agree with that because what's in it for the seller? I think Pumla, that seems like quite a difficult question. Do you want to maybe just send me a direct email? I'll quickly put it here on the chat. My email address is loans at house buyers. I think we need to have a discussion offline because that's quite a difficult question to answer. Okay, Olise, hi, I got a deal for a house worth 900,000 right in front of the TVET college. It's currently being rented and used as a common. Income is 7,200. The yard is very used. Is it worth buying? It doesn't look like it because if this is the rent you're going to get, this deal won't make enough financial sense. If you can get rent of 15 to 16,000 rand, then I would say yes, maybe it's worth buying. But that rent is too low to justify that purchase price. What I'd recommend, Lisa, is go to myapp.property.com, myapp.property.online. Oh, no, sorry, myapp.property.online. This is a tool that we developed that helps investors analyze deals. So what I'll quickly do is I'm just going to log in and I'm going to quickly run a simulator on your numbers to see if the deal would make sense. AI deal analysis. I'm just going to call this the MX deal. So you're saying 900,000 is what you're buying it for. Rental of 7,200, loan to value of 90%, student accommodation. Let's run the analysis. So here it's telling you that you're going to lose 5,000 rand, 5,500 rand on those current numbers. So I would say it's not a good deal. Okay, what's the minimum credit score they can consider? I think each bank is slightly different, but what you'll see is if you go onto clearscore.com, they've got a red, an amber, and a green color coding to your credit score. So I think between the 500 and 580 is orange or yellow, above 580 is green, and below 500 is red. I think when you start playing in the red space, that's when people are not willing or banks are not willing to loan to you. So maybe just go and speak to your banker directly. Is a pre-approval going to lower my credit score? Your a pre-approval won't lower your credit score, but what will lower your credit score is if they pull a credit report. So when you're going to go and invest in a property, the bank is going to pull a credit report on your profile. Now, for some reason, when the bank pulls a credit report, it does reduce your credit score. I'm not exactly sure why, but getting pre-approved won't affect your credit score. Leon, did you pay penalty fees when flipping using the bank financing? Yeah, so it depends on the length of time, right? The banks only start making money off a loan, I think 2 years into the loan, a year or 2 years into the loan. So if you do cancel, or let's say you do a flip and it takes 6 months to do the flip, that means the bank's not making any money. So the bank is going to charge you some sort of penalty. Again, each bank is different in their approach. So you'll just need to go and speak to your banker directly. Let's see here. What would be the difference if you obtained an Uber pre-approval as to a bank? It's going to be pretty much the same thing, Anithia. So they're going to ask the same questions, being income minus expenses, and what you're left over with will be your affordability. So if you want to use Uber, go for it. Sharda, if a home is purchased through a company, can one use it to claim back VAT? You're only VAT registered when you are earning more than R1 million revenue per year. So either you're going to be paying VAT or you're going to be paying income tax. So if you're buying from a seller who is VAT registered, it makes sense to buy it through your company that's also VAT registered, because then you get to claim back VAT. Otherwise, there's not much of a difference. Okay. Can you get more than one loan from the banks? 100%. As long as your affordability is correct, your credit score is good, and the deal makes sense, you can get as many loans as you want from the banks. I actually know of a guy who's got about 17 loans with APSA, so it's definitely possible. Okay. With regards to the JV partnership you went into with Clinton, how did the ownership of the property work? Was it registered in both your names? So what we did is we registered a company. I'm a 50% shareholder. He's a 50% shareholder, and we are both directors. That's how we've structured it. What's nice about that kind of agreement is it's really clean and clear cut. He takes 50% of the risk. I take 50% of the risk. He gets 50% of the profits. I get 50%. I would recommend that approach. Okay, can I transfer my property into the business that I am a joint shareholder in with my son? Yes, so you can, but that basically, in SARS's eyes, is seen as a sale, a transaction. So you'll have to pay transfer fees. So you'll have to pay, yeah, I'm not exactly sure what the value of the property is, but when you transfer it from your personal name into a business that you own with your son, there will be some transfer fees applicable. I would just chat to a property attorney or to an accountant. You're welcome to send me an email if you want me to introduce you to mine. Okay, Carlson, will the owner allow that rent to rent? Ha, great question. Yeah, they will allow it. The question always is, are they going to really want you to make more money off the property than they're making? So it's very hard to find a rent to rent agreement. That's always the challenge with the rent to rent is, yeah, it makes a lot of financial sense, but where are you going to find an owner that is willing to accept 30,000 Rand from you where they could be maybe making 60,000 Rand from somebody else? So, Carlson, yes, the owners do allow it, but finding that kind of deal is very difficult. What about water and electricity and other expenses on the rent to rent? So that becomes your responsibility. You have to pay for all the other expenses, be it insurance, water and electricity, all of those other costs fall on you as the new owner. Okay, which banks don't look at affordability? So this is where you have to look at bridging finance options. So the options I would give you here is look at Sentinel Homes, look at Combined Finance, look at TUHF, TUHF, look at Mercantile, look at those banks, not at your big five, because they're going to look at your affordability. Look at I think TUHF would probably be your best option. Okay, let's see here. MJ, what is your take on land grabs and how do you eliminate the risk? So, I mean, I'm not exactly sure regarding the land grabs. The current constitution or the current wording that's being spoken about in Parliament doesn't have a massive effect on residential property. It's more focused on agricultural land. To be honest, I feel that it's not going to be an issue within South Africa. I feel that our president, being Ramaphosa, is an incredibly good businessman and a good negotiator, and he understands that a good economy is underpinned by a solid property market. So, if land grabs do become a reality, it's going to crash the property market and it will crash South Africa's economy, which would be a big shame. So, I don't foresee that happening. I have had a look at the proposed land grabs policy. I've had an attorney look at it, a professional property attorney. They've assured me that as a property investor in the residential space, I should not be worried because it won't have an effect on me. Okay, Maggie, if I use a credit card for closing costs and the bank checks my debts before registering, won't that affect my finance deal, my total debt? I'm not quite sure if I understand this. Let me just read it again. I'm not sure if I understand your question, Maggie. Do you want to maybe send me an email and just word it differently? I'm not quite sure what you mean by that. And then we've got here for a first time investor, which one is better in terms of tax, buying as a PTY? It'll depend on, your income bracket, right? So in a company name, so this is similar to Carlson, right? You got to look at your taxes here. If you buy in a company, your tax is going to be 28% of your profits. That's the standard fee. Any profit you make, you're going to pay 28% tax. If you're a low income earner, someone who maybe is earning under 20,000 rand per month, your tax is going to be about 18%. So rather buy it in your personal name because you're going to be paying less tax with it in your personal name. If you're a high income earner, then potentially buying in a company makes sense. When you're looking at buying in a company, the main value add for me is that one, you can deduct your expenses off of your income before your profit is taxed. And number two, you can take away a little bit of the liability of your personal name. So buying in a company means that you aren't going to put your personal assets at risk. So those would be, in my mind, the benefits. Fantastic. I've answered those questions. Is there anything that I've missed? Um, I'm sorry if I have. I'm just looking here at any of the other questions. If there is another question that I have missed, please quickly pop it on now. Otherwise, you're welcome to send me an email. Um, I know that was quite a quick session, but I have recorded this entire session, and I will be sending this, or Apollo will be sending this entire video to you tomorrow. So you are welcome to go through it again and again and again. Please feel free to yeah, keep me up to date. If you are interested in getting some property coaching services, if you'd like me to sit one-on-one with you to go through deal analysis, to help you set up a company, to help you set up some goals, to analyze deals, to introduce you to investors, and to have me essentially hold your hand to become a property investor, go check out my link, which is lawrencebool.com/coaching. Alternatively, you can just email me at lawrence@housebuyers.coza, and I will share with you the pricing. Lastly, here are just some of the links. Go check out myapp.property. That is our tool. If you have any support questions, please email our support team. Go check out our blog. We add new and fresh content to that every week. And then if you are looking for investment deals or coaching services, give me a shout. Otherwise, ladies and gentlemen, thank you so much for being with me on this journey. I'm going to have a look at the polls to see what the most popular topic is for the next session, which will happen in 2 weeks' time. So please keep a check on our Facebook page. We will be letting you know when our next event is. Otherwise, enjoy the rest of your evening. Please, please, please look after yourself, your families, and your loved ones during the COVID crisis. Stay at home. Keep safe. Let's fight this together. And yeah, until next time, happy investing.